And what we're about to see is the next pivotal gold price revaluation event, which will once again incentivize every single foreign central bank to race again to swap more dollars to buy the same ounces of gold. Now we'll look at the footprints that assure next year's Nixon shock anniversary, the 55th one, will come around with gold having been revalued against the dollar. So not only, really, what would my question be here? What is the question? How many dollars will it actually take to buy the same ounce of gold next year? So a similar 55th year, 175% higher physical price would price the dollar gold at around $8,000 to $9,000. Now, US gold price revaluation will first force US gold reserves to become Basel III compliant.
Andrew Maguire warns that stress in COMEX's settlement system is exposing the weakness of paper gold markets and driving a shift toward Basel III compliant physical bullion, setting the stage for a significant gold revaluation. At the same time, MarketWatch highlights the vast gap between the U.S. gold reserves book value, $11 billion, and market value, $750 billion, suggesting that revaluation could deliver a fiscal boost equal to 3% of GDP. Supporting this, analysts forecast gold could climb to $8,000 to $9,000 per ounce, reflecting central bank accumulation, global monetary rebalancing, and the push for compliance with new reserve standards. Award-winning writer and market analyst Andrew Maguire points out that spreads nearly blew out to $125 due to the recent EFP basis dislocation, which was caused by banks' lack of hedging and inability to provide physical gold. Many compliance managers have therefore limited the use of COMEX for hedging, which has caused liquidity providers to shift their focus to physical gold benchmarks, such as MBridge and the Shanghai Gold Exchange. The Fed will eventually have to cover its unallocated gold bets at market pricing as a result of this move, which indicates that the LBMA-CME system is losing control. According to evidence, the BIS has already been repatriating central bank gold and squaring derivative bets, preparing the groundwork for U.S. gold reserves to comply with Basel III before a probable revaluation. According to analysts, the Fed will soon need to repurchase gold holdings, similar to what the BIS did in 2022, which would cause prices to rise precipitously. As evidence of its readiness for a Treasury-led revaluation, the Fed has publicly debated the benefits and drawbacks of revaluing gold for the first time. The Fed can only stabilize the system by bringing U.S. gold into compliance with Basel III and restoring its value to market levels because bullion banks already own gold for their own accounts. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
EFP basis dislocation was directly caused by cartel being unhedged, unable to deliver unallocated gold to hedge physical gold being called for delivery. Now, the article draws attention to the most recent disruptions that drove this EFP basis spread to an unprecedented $125, which came close to triggering this interconnected derivative implosion, with LPs now reporting asymmetrically balanced COMEX hedges are significantly being curtailed. In fact, most compliance managers would not allow, and much like we saw after COVID, most compliance managers with the second-tier banks said you no longer use the COMEX as a hedging tool. Obviously, a lot of other people do. So do the CTAs. It's no longer reliable. There are alternatives. And our LPs view this as another step that is leading to a necessary full NSFR global compliance ahead of an inevitable US gold price revaluation. Now, connecting the dots, it's no coincidence that gold revaluation talk has moved onto the front burner. There's just a few connected bullet points I kind of get into. So into an unprecedented short covering move, as we previously illustrated in screen captures taken from those Office of the Comptroller reports, the two Fed agent banks, JP Morgan and Citi had moved to close all their 5-year OCC unallocated FX gold and silver bets. That was a big clue. Empirical evidence suggests it is these siloed, unbacked FX gold bets, and they're completely unbacked, that directly relate to and asymmetrically hedge the rehypothecated US Treasury holdings. Now, with the competing SGE, the MBridge, the 7-second T+0 settlement platforms increasingly dictating a real supply-demand non-dollar denominated physical gold price, the LBMA-CME cartel will be forced to become full price takers, forcing the Fed to short cover by buying back these unallocated bets at market. Now, back in November of 2022, and as we shared at the time here on Live from the Vault, our liquidity providers were 100% on point when they were advising that the BIS was calling in and squaring all their remaining LBMA derivative bets, repatriating gold back into their sight gold accounts that they manage for central banks. Now they assess that the December futures contract expiry that's coming up on the 28th of November, these OCC bets related to US Treasury gold will be sufficiently Basel III compliant to be audited and revalued. This means a lot of Fed buying, just as it did back in November 2022. And we take this information on board and we're going to gear up for it, looking to exploit this window of opportunity to buy deeply mispriced gold and silver. And we've also evidenced the Fed repaying their BIS leases into a series of higher physically supported stair steps. We've tracked it all over time and also in the futures charts, which we've tracked month after month after month, apart from one instance, the Bank of International Settlements has been forced to close to square their bets at higher and higher prices. These are higher stair steps. However, the point we're making is, with legitimate hedging activity exiting the volatile COMEX exchange into Western-facing SGEI physical benchmarks, residual COMEX available at spec open interest is getting too thin to short cover into. Therefore, liquidity providers assess we're going to likely evidence a similar short covering move that likely mirrors the BIS exiting all its 500 tons of gold derivative bets 2 months ahead of gold being revalued as a first-tier high-quality liquid asset in January 2023. So we should expect a similar buying back, the Fed this time buying back their bets, whereas before the BIS bought back their bets. So next, and we're going through these sort of bullet points really, as we go through the gold revaluation footprints, it's really no coincidence that the Fed published a study on the pros and cons of revaluing gold. Now, the Fed has never, ever discussed gold before. While this was a hastily put together discussion on the subject, on a subject they've always denied was ever on their radar, and very likely an attempted pushback against all the White House friendly gold talk, we have reliable information from a close contact at Goldman that the Fed is being prepared for US Treasury gold price revaluation, likely in tandem with the new Fed chairmanship. With most bullion banks long gold for their house accounts, the short positions ultimately sit on the Fed's balance sheet, forcing them to bail out their agent banks, stick handling these unallocated bets. Now, the only way to rebalance is to bring US gold markets into Basel III compliance and then revalue gold.
Andrew adds that actual physical exchanges, such as the Shanghai Gold Exchange, SGE, where buyers and sellers must physically deliver and take custody of metal, are replacing paper-based marketplaces like the LBMA and COMEX in the silver trading industry. Silver is therefore more appealing to smaller countries for reserve diversification since it produces a more accurate supply-demand pricing with less volatility. Russia and other nations are hoarding silver, while the BRICS countries are aiming to accumulate cheap LBMA or COMEX silver. At about $38 per ounce, liquidity providers indicate high physical demand, which makes it challenging for futures markets to keep prices from falling. Silver recently experienced a unique backwardation, where actual silver was sold at a premium due to sell-offs triggered by futures that briefly pushed the metal below the spot price. This was swiftly taken advantage of by big buyers, who locked in discounted futures for actual delivery. Massive physical loadouts, similar to those observed in gold earlier this year, are anticipated as September contracts approach expiration, further eroding the credibility of the futures market and supporting the actual physical price of silver. Now, let's get deep into the interview.
Now, however, with silver now being priced in real physical exchanges outside the LBMA cartel's influence, where a seller of a silver bar has to first own it and a buyer of that bar has to take physical ownership of it, a real physical price is beginning to emerge in the SGE benchmark exchanges, where it's now possible to buy any quantity of silver at a physically determined supply-demand price. And with volatility greatly reduced, hedging these purchases is far less expensive. And that makes it very attractive for other national currencies to invest in silver. And so, yeah, Kerry, just as revealed by Russia, which is, again, the eighth, I think we covered this last time, but it's the 8th largest gold producer. And they're aggressively stockpiling silver as a tangible reserve asset. With silver now available in any size for small nations to access, this largely unfactored real physical demand is going to drive a much higher true supply-demand price. It's just starting to evolve. The Loco London fix is still dilutive, but increasingly benchmarks a direct producer to end user price. So any discrepancies are being arbitraged. Now, LPs report continued accumulation of underpriced LBMA-CME silver is currently in the BRICS crosshairs. So with US-driven silver futures, we just saw it again, while US silver futures got sucked into the thin liquidity vortex this past week. LPs indicate there's too much physical interest at spot $38 for it to be kept below. And obviously, we saw because the options positioning suggests 37.30 as the option sweet spot, and that the Fed has a silver short position, OCC silver short position through its agent banks, you can darn well expect that they are behind, trying to market below. They don't have silver. They can buy gold, but they can't buy silver without disrupting the entire silver ecosystem. Now, of particular note, and far too obvious, was Tuesday's farcical futures-driven sell-off that waited until silver had fixed, and then synthetically drove the spot FX silver price trade into an overnight Wednesday, this is the Wednesday lows, 9-cent premium to backwardated silver futures. In other words, the spot premium was trading at 9 cents an ounce higher than the futures market price, literally making a farce of this whole futures market, this price discovery mechanism. It didn't go unnoticed, and it's been arbitraged. And there'll be a price to pay as very large buyers locked in these massive futures discounts for physical delivery. And just as we saw as we saw in August gold futures, its first notice, and the physical buyers coming in, evidencing the largest on record backdoor bullion loadouts in gold, this month, September silver expiry next week will also evidence massive backdoor loadouts. SGE, Indian and Saudi buyers use dollar strength to exchange for silver overnight, hence the 9-cent premium in spot. So despite all this faffing around, no damage done. All it's done is expose the silver futures backdoor for an enormous loadout.
Basel III compliance and central bank accumulation are accelerating the structural shift in the gold and silver markets away from paper-based pricing and toward actual physical benchmarks. According to analysts like Andrew Maguire, this shift may soon prompt a revaluation of U.S. gold, potentially driving prices to all-time highs. Meanwhile, the physical cost of silver is rising, revealing weaknesses in the futures market and drawing strong demand from countries seeking monetary stability. Could a worldwide monetary reset be triggered by a U.S. gold revaluation to Basel III standards? Will silver become the next strategic reserve asset for central banks as it moves to physical exchanges? Please share your thoughts in the space provided for comments below. Please remember to subscribe to stay updated and to give this material a thumbs up if you found it helpful. We appreciate you coming along on the ride.